Since founding this business in 1990, we have invested in more than 50 businesses in many countries around the world, with a principal focus on the insurance intermediaries sector. Drawing on my 30 years of experience in the Lloyd's of London insurance market in broking and underwriting, we spotted a gap in the market providing startups access to capital, delivering strong shareholder returns alongside being committed partners to our investee companies, allowing them to meet their ambitious growth plans. The business has grown from nothing to net assets of over £200 million.
I think a pretty good spread of insurance intermediary investments now. We've divested the non-insurance investment that you can't get elsewhere. The reality is the listed market for insurance companies are either the big insurers or the global insurance brokers such as Marsh or Aon. There isn't an option to really invest in the insurance distribution sector in any other way other than via BP Marsh as a listed stock. And our spread is pretty good in terms of geographically and also from a product standpoint. We don't fish in the retail pond. Most, if not all, is commercial or specialist insurance in the marine and non-marine sector. And they're performing pretty well at the moment. And that's evidenced by some of the realisations we've had recently, and also the underlying performance of the current assets. Generally speaking, at the lower end of the market, there's a couple of million, you'll get angel investors providing that funding or friends and family. And then anything north of, it used to be 5, but probably 10 now, is where you get either the VCTs or the private equity funds as the enterprise value of the business increases. But that, realistically speaking, 0 to 10 million deal size is, there is an absence of other investors other than friends and family, and also, but coupled with that, it's quite a technical area, investing in insurance broking. It's regulated. It's not necessarily the easiest thing to get your head around. So we've been doing it for several decades, just investing in predominantly insurance distribution. And we feel that we've got a good handle on what it is that, or what looks good as an insurance distribution investment. And therefore we fill that gap, that we're professional investors, we're listed, we've got a track record that speaks for itself, and we don't have exit triggers. And we don't look for majority positions. So there's a variety of ways we could position ourselves or suggest that we're unique in our approach and in the area we operate. In terms of Paladin, that was previously a subsidiary company of an old investment of ours that bought itself out some years ago. The management team, for whatever reason, were looking for a new backer to buy out their majority owner. We knew the chairman of Paladin in as much as he used to work for P Marsh at his old company. He came to us for funding for a management buyout. Paladin before us was 70% owned externally and the rest owned by management. We went in there, provided all the buyout funds, but by a split of equity and debt such that whilst we provided 4 million, the majority of that was via loan and the rest was in shares, and we ended up at the end with a 40% shareholding with management owning 60%. So we rejigged the shareholder base to give management control, but also provided the 100% of the funding required, which gave us a meaningful stake alongside a good income stream from that investment. And the management team, with our backing, grew from a loss-making enterprise. I think the first year we invested, the year before we invested, it lost £70,000. We'll exit nearly 10 years later, and it'd be north of £10 million operating profit. So we'd like to think we know what we're doing when we get hold of these investments to assist management in delivering, good growth plans. There's been a hell of a lot of consolidation in the insurance broking sector, both in the UK and globally. These are entrepreneurial businesses that have been consolidated, and you can't satisfy everyone. So in some respects, you could posit that BP Marsh would be suffering from consolidation, having less opportunities to invest because there's fewer insurance brokers. Actually, it's the contrary. Because of this consolidation, it's driving people to leave these consolidated vehicles and come to us because they are entrepreneurial, they do want to set up on their own, and they know BP Marsh's track record in helping start up ventures. what you should be looking out for from BP Marsh is more of the same. Minority investments in insurance distribution companies that are at the start-up or early stage of their life cycle. We've got a good pipeline that we can pursue, but also a very strong set of existing investments that will continue to grow. Whether they're slightly more long-term or the more recent vintage of investments are all performing well to very well. So I think the portfolio is in a great position and new business is strong. I think there's a variety of reasons. One, track record. The share price performed very well over the 2023 financial year. The portfolio's strengthened, our balance sheet is strengthened with the sale of Paladin. We'll have circa £90 million available, which is transformational for the business. The existing portfolio is all profitable, is all insurance distribution, is well split geographically and product-wise, and it's a very positive time for the insurance sector more generally. So we've got a very good portfolio of investments that will grow going forward, that provides that growth. We've got a very strong balance sheet that we can either deploy for new investments or to the existing portfolio, whilst also providing, without giving guidance, a good yield for our investors from a dividend standpoint, which, if you look at our dividend trajectory, is increasing year on year and is bolstered by realisations, of which we made 2 significant ones. So all in all, looking at it, we've got the successful track record, we've got a good portfolio that's performing very well, coupled with an attractive pipeline of new business opportunities. All that combined, I would say that where we are now is very solid, very stable, with attractive opportunities for growth.